Good morning and welcome to our Capstone Coffee conversation. My name is Brett Skokestad. I'm joined this morning by Brian Felshaw. Thank you for joining us. First off, if we're having any audio issues, could you please let us know in the chat if that is the case? Hopefully you can hear us loud and clear. And
we brought the big mic.
We're good to go, yeah. But if not, please let us know so that we can try to correct that issue. As we go throughout this conversation, please let us know if you have any questions. You can also type those into the chat bar, and we will try to answer some of those this morning. Today's topic, we're going to talk about the yield curve and how it's related to recessions. I think it's a pretty important topic for now. It's kind of been in the back of our minds for a while now as far as when could a recession be here. It seems like it's been pushed back for a while. And so we'll talk about the yield curve and its relationship with a possible recession and kind of where we are right now. So I'm going to hit Brian with some questions here and we'll go from there. You ready to go?
Let's do it.
Cool. The yield curve. Can you explain what it is, Brian, and how exactly does it work?
Yeah, it's a good place to start. We got to understand what it is first. So the yield curve, it's a very fun term to throw around. The yield curve is a graph of US bond interest rates for any given bond maturity. So I think we actually have a graph, Moesha, if we can go ahead and pull that up, a nice visual that shows an example of different graphs, different yield curves from the past 18 months. And so on there, we've got December 31st, 2021, all the different interest rates available for different lengths of time, different bond maturities, 1 year, 3 year, 5 year, 10 year, 30 year. And then we've also got December 31st, 2022. And then we've got a third line there, June 30th, 2022 or 2023, the most recent yield curve. And we're kind of looking at this as a comparison of all these. So how does this work? The Federal Reserve, we've been talking about the Federal Reserve for a long time now. They control or influence rather the shorter side of the curve, the shorter side of the graph. The Federal Reserve doesn't actually control all interest rates. They only control one interest rate. It's called the overnight lending rate. It's the rate at which banks can lend money to our Federal Reserve overnight. But that one rate has an influence and kind of a cascading effect on all other rates, car loans, mortgage rates, bond rates. And so as they raise that federal funds rate, like they have been, the shorter side, the 6 month, the 1 year, the 2 year bond rates tend to get influenced as well. But ultimately, the further out you go in maturity, the more the market tends to influence the rates. So for example, if we look at the 10-year treasury rate, right now it's about 3.8. What that's saying is the Federal Reserve or the Treasury is basically saying, here's some new bonds at 3.8%. Who would like to buy these bonds? And X amount of people raise their hand and say, yes, I'll buy those bonds. And they may say, well, there's a lot of people. Maybe we can actually sell these bonds at a lower rate, not pay as much interest. So they'll say 3.5%. And less people will raise their hands and they'll say, well, we still want to sell a lot of bonds. So they'll bump it back up to 3.8. So every single day, the market is dictating kind of more on the longer end of the curve, what's happening there as a reaction to what's happening with the Federal Reserve and on the shorter end. So it's an indication of what investors are expecting for the market. And that's part of why this is important, is because it gives us an indication of what investors are thinking in terms of economic growth. So an inverted yield curve, that's another term that we hear thrown around a lot, is when we have the longer side is lower than the shorter side. Like we can see, if you look at December 31st, 2021, the longer side was higher than the shorter side. But as of the end of last year and right now, we have the shorter side is higher. It's inverted. And that means that investors are expecting longer term growth to not be as strong as near term growth. In other words, they're expecting a recession.
Let's talk for a second about the historical relationship between the yield curve and recessions. 8 out of 9 recessions since 1955 have been preceded by an inverted yield curve, okay, anywhere from 12 to 18 months, okay? What exactly does that tell us, Brian?
Well, the first thing it tells us is this is a pretty reliable indicator. I mean, if 8 of the last 9 since the 50s had an inverted yield curve about a year or so before it, that means we should pay attention to that. So April of last year, when this inverted, it's not something that you want to ignore. It's not an indicator that you want to ignore. It's historically been something economists and investors have followed for a long time to kind of see what's going on. The second thing that it tells us is it's not a perfect market timing kind of indicator, because it does give a wide range of, the rule of thumb is 12 to 18 months. It's sometimes been shorter. It's sometimes been longer. That's kind of been average, if you will, 12 to 18 months. So it's one that we want to pay attention to, but it's not necessarily a perfect market timer, if you will.
Right. So where are we now? When did this yield curve start to invert?
Yeah, so that's the big question then, right? So April of 2022, we saw the yield curve invert. We saw the 10-year go lower than the 2-year. And now we are in June of 2023, and it is still inverted. In fact, it's the deepest inversion, the biggest difference between the long end and the short end in 40 years. So we're about a year in, it's the deepest. If it's a 12 to 18 month indicator, it begs the question, like you kind of opened with, are we in a recession? Is there a recession coming? What's going on here, right? But all we know for sure is that we're in the middle of this indicator that is historically said it precedes a recession.
Right. So with this inverted yield curve, with a possibility of a recession, inflation being what it is, why is the stock market up this year?
That's a great question. That's good. Well, first off, if you've been having meetings with us, you've seen that the stock market is up mostly. The S&P 500, the US market specifically, is up and being carried mostly by 5 big tech companies. If you kind of really look under the hood, those 5 companies that hit a real bottom in October of last year, a low, I should say, in the October of last year, have really come up high this year in 2023 and kind of made the rest of the market look good, if that makes sense. It's not until June, this past month, where we saw a little bit more breadth. We saw some of the other S&P 495 kind of start to kind of catch up a little bit more. And on top of that, corporate earnings have still been pretty good. We've had a resilient economy despite all the issues, inflation, higher interest rate. There's been some layoffs, there's been some trouble, there's been some banking issues at the beginning of the year. But in general, corporate earnings have kind of been more resilient and surprised investors to the upside.
So with all we know, with all you know, how is this different? Or is this time going to be different?
Yeah.
And expecting a possible recession?
Yeah, that's always the question, right? Because we're 12 to 13 months in, right in the middle of the indicator, and yet things aren't falling apart. I guess you could say we're not in the middle of a 2008 style recession right now. We have good corporate earnings, the market's up. The short answer is it could be. This could be different, right? It's not a perfect indicator. It's 8 out of 9 last recessions and since the 50s. It's not a perfect indicator. And this could very well be different because things have been different since COVID, right? We've had money being printed, a lot of these indicators being manufactured, but I think history says to still prepare and be cautious and prepare for an economic slowdown. Now, does that necessarily mean a 2008 or a 2001? Not necessarily, right? It could be a traditional recession, but it could be more mild, right? Because things have been pretty good. We've got a record number of mortgages less than 3%. We've got record numbers of cash on corporate balance sheets. We've got a pretty healthy consumer. We could have an economic slowdown and have it be more mild. It could be worse. It could be worse, right? I think depending on your situation, you have to take what the indicator is. It's a historical indicator and figure out how to apply that to your situation.
So when it comes to conversations now, as far as Capstone advisors and Brian, your conversations with clients right now, during this time, what are you telling clients as far as how to kind of prepare for what we're about to go through?
Yeah, I mean, I guess in other words, right, how are we investing money, right? How is Capstone investing money? And the story has been very similar for the last year or so. I mean, number one, We're going to stick to our institutional process where we're keeping portfolios globally diverse. We're trying to own areas of the market that are undervalued, right? And trying to stay away from what's overvalued, trying to get the best value for our every investment dollar. And that's going to vary person to person, but in general, that's the strategy. That always has been the strategy, and that will never change no matter what's going on with the economy. We're always going to try to stick to that process. But there's a couple areas that we can talk about. So fixed income bonds, right? We just looked at a curve that had different bond rates, and there's a significant difference from what bonds were paying a year and a half ago to what they're paying today. Right. So bonds are a little bit more attractive. We have some of the best interest we've had in the last 5 to 10 years. On top of that, if rates come down a year or more from now, and we own bonds, you could see a bump in principal, right? They work inversely related to one another. So bonds get a little bit more attractive, especially if you're a retiree or just someone has lower risk. You can finally get paid a little bit more from that interest on traditionally safer, less volatile investments like bonds. For stocks, the story's been the same the last year or so, trying not to chase and overpay for the hot new thing, right? Trying to get who is undervalued, underappreciated, what areas of the market are beaten up and cheap, right? Cheap, a lower valuation, right? So that's been some of the high flying growth tech companies. We've tried to kind of not necessarily over allocate money there. We try to be more on the value side, depending on what's been a good value. But also being aware that when there are shifts and there are dips in the market, being able to pick up some great companies that are at cheaper prices. A couple weeks ago, actually a couple months ago, we had Pacer on for the Cash Cows funds, and we talked about how they picked up Facebook, or Meta rather, last fall after they took a big tumble, and how that was a great example of looking for a company that was beaten up and undervalued right at the time. So that's the kind of thing that we're on the lookout for on the stock side. Really, we want quality. We want high free cash flow. We want low debt. We want strong economic moats so they can't have competitors come and take their business very easily. And we want good dividends. That would be the other piece of that too. Right. International is another area as well. If we look at these, the yield curve and the Federal Reserve being US centric risks, international is still very cheap relative to the US. And we can kind of diversify out some of that risk of, is the Federal Reserve going to get this right or wrong? Right? Nobody knows for sure. So being international is another way to do that.
At this point, we'll open it up to any questions that may have come in.
Yeah.
Alicia?
If we know a recession is coming, why would we not just sell everything and leave it in cash?
Yeah, that's a really good question. And I actually got asked this the other day. I would say it's really tough to market time, right? Because you have to make two really good decisions. The first being when to get out and get really conservative. The second being when to put everything back in, right? It's really difficult to do, almost impossible to do, right? And so it's also important to know that the market tends to lead recessions. It tends to kind of, be forward thinking. We had a really tough year last year. We may not have seen the bottom of the market, but we may have. And so I think like Brian's talking about, leaning into quality companies, dividend paying companies right now. Our message really since the start of this year has been, be cautious but not scared. We want to be cautious during this time, but also not too scared too. So it's really tough to market time. We're just trying to kind of allocate our portfolios in a way that we can be a little more recession proof, if you will, at this point in time.
I like that. Cautious, not scared. I like that. Yeah. What else do we have, Michelle?
In hindsight, have we already had a short recession, and why is inflation still an issue?
Two-part question, right? So first one, in hindsight, have we already had a recession? It's possible. The traditional kind of textbook definition that a lot of people were debating last summer, I want to say, was it's 2 quarters of consecutive negative GDP growth. And that's kind of been the colloquial definition, right? That's been and that's true. But actually, we had a capstone coffee conversation about this at the time. There are actually a bunch of metrics that qualify for an actual recession, and we didn't hit all of those. Unemployment has to get up above a certain level, and there's a few other. Manufacturing index has to change to a certain level. There's a few other definitions as well. So I think there's been a lot of confusion over, are we in a recession? Are we not in a recession? And I think we're still trying to figure that out. I don't think anybody has the right answer, or is it still coming? Because there's also consideration of, is this a rolling recession, right? Where we have certain pockets of the economy that are in a recession while others are succeeding. And then, now it's the next sector's turn to kind of go down. There's been some of that as well.
Yeah.
So it's a unique situation for sure. I don't necessarily know for sure if we were in one or not. It hasn't been necessarily stamped, yes, that was a recession. That could still happen. But we're definitely still in a more difficult economic situation, right? Second part was inflation, I think.
Yeah, inflation, it's come down, it's come down from 9% last summer to less than 5%, I think now, or right around 5%. So it's been easy to get from 9, easy, I say in quotes, from 9 to 5, now getting to where the Fed wants it to be at 2.5. That's going to be the difficult process of being able to do that. I'm not sure if we're gonna be able to get all the way down to 2.5, but we'll see.
Yeah. And I guess I'd add, we still have an economy where we're still spending money. Americans love to spend money, right? We still have on services, we're still spending a lot. And so inflation doesn't come down instantaneously, right? It takes time to work through all the money that was printed during the pandemic and is still being spent. Yeah. Okay.
Yeah, thank you, Brian, and thank you for joining us today. If you have any questions or anything that transpired during our conversation, please feel free to reach out to your capstone advisor, and we'll have conversations there. But thank you very much for joining us. We hope to see you next time.
Yeah, thanks everyone.